Well, thank you, everybody, and welcome to the fourth annual Market Watch. My name is Ross Keogh, and I'm going to help just keep the event moving forward today. I have a few announcements before we begin. First of all, if you do, there's Purell both back at the bar and at the front desk. We're in full-on COVID-19 protocol. So if it's an elbow bump or a namaste or a handshake, depending on where you're at, go for it. I have it on, moderate authority that IPA and COVID-19 don't get along very well. So I think the bar will be open during the event. Don't feel shy. Great. Well, thank you, everybody. And, we've had a very dynamic couple of weeks in the market, I think also in the commercial real estate market. And we just have a fantastic lineup of speakers today. And I certainly am part of a lot of conversations talking about what it means to be in a bubble, right? And we see these corrections and we have questions. And I think it's important to go back to the fundamental definition of a bubble, right? A bubble is when intrinsic pricing and the posted price that you see diverge. And for those of you that have been part of Market Watch, this is fundamentally an event about understanding intrinsic pricing in the commercial real estate market in Western Montana. And that's been happening for 4 years, and you've been all of you have been a part of that conversation. And I look around the room, I see bankers, I see attorneys. I know we're recording it for a few CPAs that are hoping the IRS extends their deadline. And I see a bunch of people who own assets, bankers that make investments in this space. And as you listen to today's speakers, and we've got some great ones, ask yourself, what does it mean for this market, for Western Montana, that these groups of people are having a conversation every year about the intrinsic value of real estate? And what does that mean for markets where that conversation, say in Montana, isn't taking place? And how important is that for us as we look at this type of asset class and understanding it? So with that, I'd like to introduce Matt Malott. And in particular, I'd like to introduce Matt's iPad. For those of us that have had a meeting with Matt, we know full well how important that having that technology information available is for Matt and everyone else's team. And that iPad is really just what makes Sterling special, but it embodies the entire team that supports this. And so let me make a few recognitions today for those that are part of the Sterling Commercial Real Estate team. We have Claire Matten, who will be speaking today. She is a CCIM. We also have Jessica Marina here up front, who will be speaking. In the back, I see Corey Miller, who helps out on the commercial asset management side. Will Holm helped put this event together. Where are you at, Will? There's Will. Maggie. Is Maggie still at the front table? Excellent. And Summer. Thank you for your help. Fantastic in the back. Great. Well, with those thank yous and without any further ado, let me introduce Matt and we'll get it started.
Okay, thank you. We live in a VUCA world, and if you've never heard that acronym, it stands for volatility, uncertainty, complexity, and ambiguity. So this is the cloud that makes the future scary for businesses and investors. So when you hear talks of pandemics and trade wars, falling stock prices, recessions, rent control, presidential elections, that is VUCA. That's the cloud. Without the context and clarity of data and analysis, in a VUCA world, prediction of the future is basically folly. I can predict with certainty that we will all pay taxes and that we will all eventually die. But beyond that, trying to understand reality as best we can, and then looking at what the data tells us about future opportunities and risk and making decisions accordingly is the only way to proceed in a world that is full of VUCA. So Missoula Market Watch is in its fourth year, as Ross mentioned, of collecting and analyzing Missoula commercial real estate market data, development activity, and then broader industry trends into a consolidated intel briefing, which is what you'll hear over the next hour and a half to 2 hours. Our hope is that commercial property owners, tenants, investors, developers, and the people who advise them will take the information into account that we present here for their decisions that they make in 2020 and beyond. So what we discuss here in the next 2 hours is important. The built environment, basically most of the things that we enjoy about life and work and play come about through development and capital investment and diligent management of assets. even this hotel or housing, workplaces, schools, shopping, all of that are the result of capital investment into real property. We do Market Watch because wise investing isn't just about money, it's about the effect of all of this. It's the effect and the end result of putting sticks and bricks and people and ideas together into places to work and live and play. So the one thing that we preach here is data-driven decision-making. So have a firm grip on reality and then make decisions accordingly. So whether you're an investor or a tenant or a developer or a lender or a builder or designer or an attorney, this should help you to identify risk and spot opportunities. So here's a preview of what we'll be talking about tonight. There'll probably be a little bit of this and maybe a little bit of that and probably some of this. Should give you a pretty good idea of what's coming around the bend here. Speaking of roller coasters, I think most people will probably recognize in the last 3 weeks there's been about a 5,000 point drop in the Dow, which looks pretty scary. But it turns out the world is probably not coming to an end just yet. But what this does show, 5,000 point drop in the Dow, is why ethereal investments in stocks with no physical presence to them have a lot of volatility. Real property assets, though they are not immune from fluctuations in value, generally are tangible and less prone to these wild swings. So it's for this reason that in times of volatility and uncertainty, well-managed commercial real estate assets tend to gain favor. So before we introduce Bryce Ward, we'll cover a couple of the key demographic pieces. And while this may look boring to talk about demographics, when you consider real estate and how to invest wisely in it, you have to understand these fundamentals because it drives the conversation here. So this is countywide information for Missoula from 2019. At the end of the year, we had 122,370 people, which was a 2% growth from the preceding year. So that's about an increase of just under 2,500 people in 1 year. Probably the best news that you'll see is that median household income, at least according to the American Community Survey, is up almost 8% year over year, which is a great thing for the average person in average household in Missoula. Corresponding, we have a big increase in jobs, 2%, very close to what the population growth is. And lastly, the unemployment rate is up about half a point, which may look bad, but considering that 5% or below is more or less full employment, Missoula is in pretty good shape. So next we'll introduce Bryce Ward, who is an economist with ABMJ Consulting, who will talk more big picture about the kind of the national scene and some of the hot topic items that you may or may not have heard of in the news, and then cover a little bit about how that will impact the state level in Montana and then in Missoula as well. So Bryce is the co-founder of ABMJ Consulting and an economist with the University of Montana. He has a PhD in economics from Harvard, which is the best he could do, and BAs in economics and history from the University of Oregon. He has expertise in urban and regional economics, labor economics, health economics, public finance, social economics, real estate economics, environmental and national resource economics, and econometrics. He's pretty much got it covered. He's taught at Harvard, Lewis and Clark College, the University of Oregon, and Portland State University, and has published dozens of scholarly articles and economic reports. So without further ado, here's Bryce Ward.
It's always good to be an economist at times like these. So normally when I give a talk, the talk that I actually, when Matt asked me to give a talk, I was going to give this talk. So, Missoula's economy, what's going on and how do we do better? It's a very big picture, long term. The reason these are my kids, the reason I put a picture of my kids up there is that ultimately what we're trying to do is trying to make sure that when they're my age, that Missoula has a lot of opportunity and it's the kind of place that they want to live in. So that's the talk that I had planned on giving to you today. And then some things happened. And I'm actually really happy that the bar is already open. Because usually I'm the one between you and the bar. I've actually never had the opportunity to be like, hey, people are already drinking. Hopefully you have already been drinking. In fact, I'm going to join you. The last time I drank alcohol while giving a talk was literally I had to teach class right after I defended my dissertation. And like at Harvard, because a certain faculty member made a whole bunch of money, he buys champagne for every single dissertation defense, right? So you get a bottle of champagne after you defend. And so I drank with my advisors, and then I went off to class with my bottle of champagne in hand. And, I was like, I probably shouldn't be doing this, but whatever. I just graduated, so I literally just drank champagne. As I taught class one day, this is not that. I'm not drinking in celebratory mood right now. In fact, this is kind of what it feels like to give a talk on the economy right now. It's, like, what's going on? I don't know. Every hour, something changes. Has he made it all the way down yet? And then, I think it cuts off. But if you were watching the actual cartoon, that little rock would fall on him. And that's kind of what it feels like right now in the economy. So before we can understand what this means for the economy, it's worth trying to understand what's the underlying issue and why are we, in this situation. So, this is the three phases of a pandemic, right? So we kind of have phase 1, phase 2, phase 3. Let's talk about each of these phases. So the first phase is the exponential growth phase, right? And so exponential growth is big and powerful, right? So you can see it goes very, very steeply, right? And kind of in a do-nothing scenario, at least a week ago when I started this, cases were doubling every 6 days in the United States. Currently, they're doubling in less than 3. So at the 6-day rate, we'll have 1 million cases by the end of April. According to things that literally I saw about 2 hours ago, congressional testimony today by some doctor person suggests that 70 to 100 million Americans will likely be infected with coronavirus. That's a big problem. Why is that a big problem? Well, hopefully you've seen this by now, but if you haven't, this is the issue. It's called flatten the curve, right? So the key thing here is the dotted line, which is healthcare capacity, right? Because right now we have hospital beds and all that kind of stuff, but most of them are already full. So if we add, and right now in Italy it's about 10% of COVID patients require ICU, 15% require some form of hospitalization. So, 1 million people, 150,000 people requiring hospitalization, we don't have that kind of healthcare capacity, right? So the issue that we're trying to deal with and why we have an issue in our economy is not because it's necessarily the most deadly disease in the world, although it's much worse than, the common flu. It's that we don't have the capacity to treat it, right? So we have to somehow figure out how to flatten the curve, right? Because if we don't spread out the disease, make it delay how long it gets there, the healthcare system gets overrun. And when the healthcare system gets overrun, you have a problem, right? Italy has shut itself down. Why? Because its healthcare system was getting overrun. And you basically are ending up in a situation where just the patients with CVOID 19 are basically filling up the entire hospital, which now then means that if anybody else needs treatment, there's not enough space for them. And when you have that, you end up with panic and you end up with lots of problems. And so and that's where you start seeing, larger, stronger efforts to engage in what we call social distancing, right? So this is how we try and mitigate it, right? As we say, look, epidemic is pretty straightforward. You take a sick person and they interact with a certain number of people, a certain number of those will get sick as well. So basically you have the number of people you interact with times the probability that you infect them. And so if we can try and reduce the number of people that a sick person interacts with and reduce the probability that when you interact with a person that they get sick, then we can slow down, we can flatten the curve. And so we start doing things like, closing school and canceling travel. And as of today, all the March Madness games will be played in front of family only. Right? So you start canceling large events in order to try and slow down the spread of disease. And the good news is that this actually does work, right? So this is what's happened in Hong Kong. This is basically all the different kinds of diseases. And, red is flu. We can just focus on the red. And basically, that's last year. You can see the flu spike, and then it comes down. And it was starting to go up, and then they basically imposed mandatory social distancing, and they don't have any infections anymore. They're not even spreading just coronavirus. They actually aren't spreading flu. They're not spreading gastroenteritis. All the infectious diseases, they basically disappeared because guess what? We spread infectious disease. Similar, this is what happened back in the Spanish flu in the US. Based on how long it took us to impose social distancing, you can see basically the longer it took a city to impose social distancing, the more people ultimately died. So, okay, social distancing works, but it's really costly, right? And that's ultimately what we have to deal with. And so the question is first, okay, it works. How expensive is it, and how long will it last, right? And so the hopeful version, we're trying to get to phase 3. And the only way we're going to get to phase 3 is either with vaccine, with treatment, everybody gets it, or, and this is what we're kind of banking on, hopefully in the most optimistic scenarios, is warm weather, right? That coronavirus follows the flu virus and basically has a seasonal pattern. And this is the optimistic view of that. Right? Basically right now, all the black circles are the main places where we have outbreaks. And you'll notice that they're all in this one little color band of climate, right? And so the hope is that as summer progresses and the red moves up, in at least those yellow places, it will stop spreading. Now, the problem is, of course, the yellow line just moves up, and then it also moves up in the southern hemisphere. And if we're here in Montana, you'll notice that we're just getting to the right temperature, right? Basically, April and May is when we're in the yellow zone. And so, we'll see. Hopefully it's really not spreading in the orange and red zones, and so once we get to July, it'll stop. But we don't know that, right? This is a brand new virus. We have no idea what it's going to do. So we have to kind of start thinking about, well, what does this actually mean? So what does it mean for the economy, right? So the first thing, so I gave a talk in Billings a couple weeks ago, and I actually, I kind of hinted at coronavirus, but I had other things to talk about. It was 2 weeks ago, and so it was kind of like, coronavirus. It wasn't as serious yet. But what I had prepared to talk about then was this, right? The thing, 2 weeks ago, we were mostly concerned about the supply shock, right? So basically, China has shut down. China is 16% of the world's economy, and, there was concern that because China's not producing anything, the supply chain's going to get disrupted, and we're not going to be able to produce the kind of output that we wanted to be able to produce, right? And this is basically just shows you, so the figure on the left, that's pollution, right? And you can see kind of what normal pollution looks like in China, and it all went away. Because they're not producing anything. And over here, just as an illustration, this is kind of shifts at the Port of Long Beach. They're down, what does it say? They were down, 21% in the first part of 2020. Chinese exports thus far this year are down 20%. So, there's a big goods supply shock in the pipeline. And that's what we were kind of worried about for a while. But as you get to the fact where you're starting to impose social distancing, and this is a bigger deal for an economy in which majority of our economy is in the service sector, is we're starting to see supply shocks in the service sector, right? And, I'm on various academic Twitter, so that we've been seeing this for, longer periods of time, is basically all the academic conferences got canceled, and then all the travel for all the academic institutions got canceled. And now you've got to the point where many colleges and universities are sending their students home for the year. So there's Princeton, they were the first one to do it. After spring break, don't come back. Leave, don't come back. Okay, that's education, but this basically ripples out into the rest of the economy, right? As Google has told people to only work from home, and all these other tech companies are telling people to only work from home, and as travel gets canceled for everybody, there's going to be output losses, right? Some of us can work from home. I work from home. But most of us can't, right? So I didn't do this for Montana. I just stole from something that the Oregon Economic Analysis Department did. But Montana actually looks a lot like Oregon. We have about the same percentage of people who already work at home. So you can see that, some people maybe will be able to produce output at home, but a lot of people will not be able to produce output at home, and particularly as you move down the wage scale. And so, okay, well, if I can't produce output at home and I'm being told that I can't come to work or I shouldn't come to work, well, how do I get money? Well, some of us have, at least sick days that we can use or vacation days that we can use. But again, for low-income workers, very few of them, less than half, have any form of paid sick leave, right? So there's going to be some output that isn't produced in the service sector, and that will be lost forever. But then it starts to ripple through, right? If I'm a service worker, so if I was a server who was going to work at South by Southwest that now got canceled, South by Southwest is the kind of, windfall for servers in the Austin area. Gets canceled, I don't get money. So if I don't get money, I don't buy things. So now we move into the demand shock, right? So not only do we have a supply shock going on, we have a demand shock, right? So this is an actual picture of an airplane from last week with nobody on it. We now are starting to get data. So here's the year over year changes in U.S. travel sales, and you can see that just like, not this last week, but the week before last, things were pretty red. I saw United said that bookings are down to 25%, and if you add bookings and cancellations, they're down 70%. So, you're starting to see big ripple effects through certainly, travel and entertainment. Concerts are being canceled, as I mentioned. Large sporting events are going to be played without crowds. So, there's going to be demand side ripple effects that, from all the people who would have gotten money from doing something that are not going to get money, that they're not going to spend money. They're also not going to spend money because they're being told not to do stuff. Stay home. Don't travel. And so when you start losing money, many of us, it's fine. Like, I'll go home. I'll hike up the mountain, right? I have money in the bank. I will be fine. I also can work from home, and I have clients who will be continued paying me for the next several months. But not everybody's in the same kind of financial situation, right? So this is basically how, this is a survey from the Federal Reserve that basically asked people, households, how's your financial situation? And in 2018, we were looking pretty good relative to 2013, right? Only about 25% of people were finding it difficult to get by or just getting by. But that's still a quarter of people. And if you just went back 5 years, when we were already 5 years out of the Great Recession, it was much higher. We're probably pushing back towards that level of a large share of people who are going to be finding it difficult to get by. That will compound the demand shock in certain areas. And then you compound it further with so these are real. Okay, we have don't work, lose output, don't earn money, can't buy stuff. But then we also add panic to it, right? If you've tried to buy toilet paper or Purell recently, it's hard to find. So this is somebody I went to graduate school with. He actually then, put the whole Twitter thread together, which basically argues that the toilet paper run is just like a bank run, right? It's basically people kind of being afraid that there's not going to be toilet paper, so they go out and buy toilet paper. And you can tell that it's a kind of a weird psychological phenomenon and not an actual shortage of things to wipe your buns with. Because if you went to Costco like I did on Sunday, the toilet paper's gone. But you can buy paper towels, you can buy napkins, and you can buy tissues, right? Those are all just completely normal, right? So there's a panic, right? And we actually now have 3 panics going on. The health panic, the real economic panic, like I'm not able to work and earn money. And we have a financial panic, right? Which is the stock market issue that Matt showed you earlier. And just for fun, just because there wasn't enough going on, let's add an oil price shock, which is at least sort of related to this whole issue, but is in part just related to, Russia and Saudi Arabia having a little bit of a fight. And it's worth noting that, the last time we saw a big price decline like this was in 2016. And that alone is largely responsible for what we call the mini recession of 2016. It wasn't an actual recession, but there was a mini recession that year, particularly in the industrial goods sector, that kind of dragged down a lot of certain parts of the country. So we're likely to see that force get added to just the already pandemic forces. So you put that all together and you get something that had never happened before in the entire history of the United States, which was the entire yield curve for US Treasuries being below 1%. Right? What does that mean? Well, basically bonds tell us what people think about the future, right? And when people are saying, I don't think there's anywhere it's good to put my money. They go buy US Treasuries. And when they go buy US Treasuries, the interest rate plummets, and we basically end up with what we have here, which is that basically the US government can borrow it and get money back for the next 30 years, right? The real interest rate on a 30-year bond is negative. And that's good if you want to borrow money, which we're probably going to need to do. It's bad in terms of what it's telling us that at least the market thinks about the economy, all right? So what does this all actually mean for Missoula? Well, I don't know. We've never seen this before, right? So, I'm Wile E. Coyote out over the cliffs, like running around going, where's the data? Where's the data? I don't have any data. So when we don't have data, let's just use some basic logic, right? So there's basically 4 main things that are happening. So first, there's going to be some output that disappears forever, right? That's just lost. It's gone, right? If I was going to travel someplace, then I say, you know what? I'm not going to take that trip and don't make it up later. It's gone, right? If I say, you know what? Let's not go out to eat today. I don't want to be around a crowd. It's gone. If a conference gets canceled and we're just going to say, well, we'll do it next year. We're not going to do it this year. It's gone. Right? That's output that will never materialize. It's just gone from the economy. Okay, that's big, and that's the important thing. That's the most important thing. But there's other things going on, right? So some of it will just be delayed, right? So I won't buy something now, but I'll do it in October when hopefully things are better. And so that's just pushing things around, but there's a problem there in that if too much of us push too much all into the same period of time, things will get too congested, and some of it just won't end up doing it. I'll say I'm going to do it later, but then when I try and do it later, it will be too much, and I won't end up doing it. There's a lot of stuff that actually will just continue as normal, right? I still need to eat food. I still hope the lights turn on. I want my toilet to flush. I want, my cable TV to work, all that kind of stuff. I want lots of things on the internet to distract me. So, that stuff will be unaffected and it will continue. And then, of course, there is the flip side of things that are actually going to grow as a result. Unfortunately, healthcare, but also, if you're in the sanitizer business, it's not a bad time to be. Also, the toilet paper business apparently is booming. And then there's some spillovers, right? So as you get through things being lost and things being delayed, you'll start seeing bankruptcies and defaults, right? And so this is really the problem that we face, is what we really want to do. If we're going to do the public health right thing to do, flatten the curve, engage in social distancing, right? We really want to press pause on the economy, right? We basically want, if you're a necessity, if you're healthcare, if you're food, if you're energy, okay, you keep going. But basically what we want to do with everything else is just press pause. But the economy doesn't have a pause button. And so now we're in the business of trying to pick winners and losers. Who's going to win, who we're going to bail out, who's going to get money, how much are they going to get, which is going to be a mess, and it's going to be a disaster, particularly in a low-trust society that we currently live in, right? So ultimately, what does this all mean for Missoula? Well, a lot depends on how long do we need to engage in this, how much is ultimately lost, how long are things delayed, and what's the federal fiscal response. But it's worth, of course, noting that, 12% of workers in Missoula work in food service or something similar. Another 3% work in kind of events and that kind of stuff. We have 15% are in office and administrative support, and that includes the people that work at the front desk here at the hotel. So there's a large proportion of Missoula's economy is likely to suffer a big lost shock. So we don't know how that's going to be dealt with. And then there's other parts of the economy which are in kind of some parts of it might actually get lost, right? In fact, the Washington Post just this afternoon published an article on, trying to track people who are already losing their jobs. And the biggest number they found is 150 truck drivers at the Port of Los Angeles, right? Going back to those shifts, right? So if I'm a longshoreman, I still get paid by the contract. But if I'm a truck driver who, basically drives it away from, and I'm not part of a union that's basically guaranteeing my wages, I get laid off. So 150 truck drivers have already been laid off at the Port of Los Angeles, and obviously you see a bunch of travel stuff and yada, yada, yada. So to the extent that we have a fair number of people that work in transportation, some of them may also be lost, or at least be on pause. And so, I think I'm running out of time. So the short version is we need to press pause, and we need to figure out how to press pause in the least costly way possible, because we don't want to destroy the economy so that it's a bigger mess to pick up. That's what we're trying to figure out how to do. Whether or not we'll be able to do that, who knows? It's up in the air. How long the pause button will need to be pushed, who knows? It's up in the air. So there's, what was VUCA? Yeah, the VUCA cloud right now is the biggest thunderhead tornado cloud hurricane you've probably ever seen, right? And I include 2008 financial crisis. 2008 financial crisis, it was a shock, but it was pretty easy to kind of figure out what was going on once it happened. This is something that we have no idea how long it will last, what it will do. And I say this not to scare you, because that's not my intent, but my point is to say we are in a huge uncertain time, and so we need to be trying to resolve that uncertainty as quickly as possible and as calmly as possible. I think I have a minute left, so I will take at least one question, because I'm sure there are probably some out there. Or I'll just continue drinking, because that's kind of what it feels like after this kind of information dump. That was a joke. I was like, I saw they had it, and I was like, of course I have to drink a Corona. All right, everybody's just too panicked or in too much of a stupor. All right, well, I'll hand it back to Ross. You coming up here?
Thank you, Bryce. Let's give Bryce another round of applause. It takes a lot. I spent all weekend, or a good portion of my weekend, trying to figure out a whole bunch of things about the virus, and I wish I would have just waited, and I really appreciate it. That's a very concise and helpful summary of the risks of COVID-19. So thank you again, Bryce. And I hope to, at some point, hear your broader presentation on the Missoula market economy, so maybe we can get that available for everybody here. With that, Claire Matten. And I just, Claire, and I've had the opportunity to work with Claire in a number of different contexts, and I've just been continually impressed by her capacity in the commercial real estate space and ability to get stuff done. And this year, I don't know if everybody's aware, but Claire learned a particular designation. She is now a CCIM. And this is a designation that is only achieved by about 5% of all commercial realtors in the United States. And it requires a lot of time, effort, and there's actually a test involved. And so if we could give Claire a big round of applause on reaching this really important milestone. Thank you, Claire.
Thank you guys so much for coming. I will not be drinking during my portion of the presentation. If you came last year, you'll notice I've completely let myself go. I do have an extra passenger with me, though. So I'll be quickly covering the industrial and retail asset classes as we move through the presentation and reflecting on 2019 and talking about some projections for 2020. So what you might have noticed in recent years is that the industrial sector has kind of evolved into sort of the darling among investors and developers. And while not everyone's in love with the idea of owning, a plain Jane manufacturing building or a flex building, there's a big reason it's become so popular in the past 5 to 7 years. And a lot of it's because, if you think about it, everything goes through warehousing. Every consumer good that you and I touch makes its way through a warehouse or distribution facility at some point, and that type of real estate cannot be outsourced away. So for example, if we have a housing downturn, we see people move in with friends, kids move in with their parents, office workers can telecommute to save on office rents. Retail, we're in the middle of watching what retail does and vacating some larger spaces, but really there is little or no substitute for industrial property. And so in talking about the love affair with industrial real estate, we have to talk about e-commerce a little bit. It's not earth-shattering information at all when someone says that e-commerce has been a big economic factor in the overwhelming success in the industrial sector lately. This is from the Bureau of Labor Statistics, and you can see the quarterly growth in e-commerce sales from 2010 through fourth quarter 2019, and you'll notice that it has gone in only one direction. E-commerce sales were over $600 billion in 2019, which is almost 15% of an increase year over year. It's also projected to increase by almost 15% in percentage that it accounts for of retail sales moving forward in the next 3 to 4 years. So this is moving beyond Amazon. This is moving beyond Walmart. This is your social media. This is your influencer market. This is third-party logistics contributing to this incredible growth in this industry. Okay, so moving forward, a lot of this e-commerce model depends on the national distribution, supply chain logistics, and what's interesting about these maps is you'll notice pre-2007, the turnaround time for same-day or one-day delivery versus 10 years later. And this is even a couple years older, so the Northwest is likely in the dark blue quadrant as well, with Montana probably moving into the light blue. There's probably still a few areas that are in the gray, 3+ day deliveries. But with shipping costs, with the bigger metro markets making up close to 28% of the cost to get your goods to you, there's a new trend coming out called last mile logistics that I think Montana's really poised to benefit from. And that's basically anywhere between a few blocks to 100 miles away. And it's how they get that last part of the shipment to you. And what those groups are looking to do is move from the bigger metro markets and absorb existing industrial space or old retail space. And an abandoned retail space a lot of times has good loading capability. And so they tend to avoid build-to-suit projects. They don't want to make that long-term of a commitment, and the rents for build-to-suit projects usually don't tie into the cost-effective model that they're after. So we see a lot of these bigger companies moving into our market probably in the next couple of years trying to absorb some more industrial space. So besides e-commerce, besides all that, who else are the emerging users among industrial product? Third-party logistics, like I mentioned, these are the groups that do order fulfillment, packaging, shipping, handle returns, store your goods, handle all of it for you. They are actually the largest absorber of industrial space in the last couple of years. Manufacturing is still in good shape, so that's going to remain at the top of the list. The food and beverage industry is changing dynamically with grocery delivery on demand shifting, pre-prepared meal delivery companies kind of emerging like HelloFresh, things like that, is creating a really high demand for cold storage, which cold storage in the past has been really considered high risk, niche real estate. Now you see a lot more developers putting together projects that have cold storage capability or speccing even a little bit of cold storage space out. Tech and telecommunications companies, these are even your 3D manufacturing, 3D printer manufacturing, 3D printing companies. They're absorbing a lot of space. Telecommunications, cell phone tower installation companies, they've got a lot of equipment, and they're absorbing quite a bit of space as well. And love it or hate it, cannabis is probably not going anywhere anytime soon. And as more and more states approve recreational use, you're going to see a lot of cannabis users looking for industrial product to run their grow operations out of. Excuse me. So now let's take a look at one of our favorite real estate demand models. It's the Mueller cycle. You've seen us reference it in years past. And so what the Mueller study does is uses long-term occupancy averages compared with rent growth to determine where a certain asset class lies within a given real estate cycle. And so the point of equilibrium, or the number 11 that you see there, that sits at the point where the rent growth starts to level off. New construction rents and demand starts to level off, and new construction rents aren't growing at a point to support current construction costs. So we reference the cycle each year, but we took it a step further this year, and we're trying to identify where Missoula sits in the cycle. So while the U.S. as a whole is creeping towards the equilibrium point, I think because of the last mile logistics concept we talked about, and as some of the larger markets head toward hypersupply and saturation, we consider Missoula still in the 8 to 9-ish point. We're going to go conservative and call us a 9. So we're still in the expansions phase, and we are predicting some rent growth as we move into 2020. So quickly, we'll just kind of look through some regional rates. Something to note, obviously your cap rate column, cap rates were compressed in 2019 versus 2018. Very indicative that investors and developers are putting a lot more value on investment product versus 2018. Rent growth in straight industrial properties grew 2%. The flex properties that you typically see, a lot of them are really specialized, lower ceiling heights, 30% or more office. And so we're seeing a little bit of a straying from those and more absorption in just the straight industrial product. Here's some cap rate reflections on Missoula. Not a ton of investment activity in the industrial world. A lot of people holding on to their assets, but the flex, one notable flex project that traded just above a 7 cap, the self-storage transaction, there's one notable storage transaction that traded at a sub 6. I would not call that a typical cap rate acquisition. I believe it was an exchange buyer, and so I would say cap rates for storage are closer to mid 6s upwards towards 7. But all the cap rates reported are below national reported cap rates, as you can see. Moving towards vacancy rates, Missoula actually started off with a 4.5% vacancy rate in 2019, but as we move through the year, Q3, Q4, there was some dated product that hit the market, Bonner area. The Smurfit site was kind of in question for a long time with environmental concerns, and a lot of that's been cleared up. So there's about 85,000 square feet of that Smurfit site that we feel is good usable industrial space. So we accounted for that towards the end of 2019, which caused that vacancy rate to bump a little bit, but we do anticipate a lot of that product getting absorbed. Just some significant industrial sale transactions. Number 1 and 3 on here are probably more your straight across cap rate for industrial transactions. Number 2 as a single tenant deal with some term left on the lease that was purchased by an exchange buyer. So a sub 6% cap rate's probably not indicative of the market, but it did contribute to some compression in the cap rates. Overall cap rate for 2019 was 6.36%, down from 6.98 in 2018. Price per foot overall went up almost 4% to over $103 a foot over 2018. So you definitely see good interest in the industrial sector here last year. That absorption number, it might look like, negative absorption, that doesn't make any sense, but that is contributed to a number, a big chunk of the Smurfit site and Bonner hitting, and one other large building hitting the market at the end of the year. So again, we anticipate that square footage to be absorbed as we move forward. Slight drop in rents, and we're guessing we're not guessing, we predict that that's because of straight industrial product tends to bring in lower rental rates than flex because of the lack of the office component there. So more absorption of industrial product has brought that overall average rate down a little bit, but we're already tracking about 5 or 6 leases so far on just pure industrial product at about $7.50 a foot triple net. So we're already anticipating some pretty healthy rent growth in 2020. We keep a real close eye on development. So just we track what's planned, what's rumored, what's under construction. We delivered just under 70,000 feet in 2019. We've got almost 250,000 square feet planned moving forward. So some of those planned developments include Summit Beverage, that's over 100,000 square feet. There's a spec flex project out by the airport that's planned, that's 120,000 feet. So those are some of those projects that contribute to those numbers. And as you see on the map, it's all out west. So as we wrap up industrial, we're just going to talk about some investment opportunities and then the risks. Our small bay users, they still want to own their space. So there's a lot of great projects out there that offer lease opportunities, but if you have access to land at a cost that makes it viable to build something that you can turn around and sell to your users somewhere between 2,000 and 8,000 feet, We think there's a lot of opportunity there. Improve efficiencies of your existing facility, or if you're building cross-dock loading for faster deliveries, higher ceilings, solar power to manage your rising operating costs. Consider the location of your asset. If it's in town, almost impossible to rebuild. When you go to renegotiate your lease rate there, keep that in mind because that is added value to your project. And then try to coexist with some retail. I know Nike has a big facility in Memphis where you can go in, design your shoe there in the front, and then they'll make it in the back for you while they're working through their warehouse, their normal distribution stuff. And you can walk out of that facility with a brand new custom pair of shoes that day. So if you can kind of blend some sort of customer interaction in your industrial facility, you should have some success there. And your risks have really not changed from last year, other than coronavirus being added, I guess. So trade-related risk, cost of materials. We got to monitor consumer spending. That'll have an effect on e-commerce. Labor shortage. There's a lot of groups that want to expand and can't because they don't have the manpower right now. And then just to watch on oversupply and overbuilding. So that's as quick as I could have gone on industrial. And quickly we'll move to retail. So I don't know if you guys have heard this before, but I know, Matt, you brought it up the other day that a lot of times industrial and retail are considered sister assets. And I think it's safe to say that 2019 might have caused a little bit of conflict between the girls as the rough around the edges industrial sister kind of emerged as the favorite over the a more aesthetically pleasing retail sister. But they actually really get along quite well when you think about it, and they do continue to interchangeably fuel one another. And retail still boasted over $50 billion in transaction funds nationally in 2019, despite challenges like fickle consumers, e-commerce competition, excess inventory, investor aversion. And so a lot of people are talking about the demise of retail, but it's really just kind of reimagining itself from the focus of location, location, location to location, experience, and analytics. And when we talk about analytics, there's a huge shift on who retailers are really starting to pay attention to. They're moving away from the silver tsunami and the millennials, and they're starting to focus on Gen Z. And what's interesting at Gen Z, 1997 to 2010, was when they were born. They're entering the marketplace heavily right now. And these are kids who are digitally engaged all the time. And when they were polled, over 80% of them still want to shop in stores and still want, over 70% still want to discover new products in stores. So they're looking for a touch and feel, physical experience to disengage from all of this techie online e-commerce. And they have tremendous spending power. But not only do they spend themselves, with social media and social media influencers, they can influence over $460 billion in spending from their sphere of influence. So the other interesting trend with Gen Z is that now the parenting style with Gen Z has shifted to where the parents are now very concerned. 87% of parents now say that children, their Gen Z children and younger, influence their purchase decisions for household items for the kids, for themselves, and it's shifting the way they shop. So 84% of people are more likely to shop at a retailer that makes it easier for them to involve their kids. So some of these retailers have picked up on it. So Disney and Target are now partnering for a retail-tainment concept, and Disney's going in and putting in these pop-up shops, if you will, in Target, and they have music and interactive stations and merchandise and areas you can take photos. And so it's an immersive experience for the kid, for the grown-up, and they get the shoppers coming into the brick-and-mortar locations to go experience this retail component. So I think that's part of the dynamic we're going to see shift as we move forward. Lots of media on every closed door, especially in Missoula, right? But for every closed door, there's a lot of new doors opening that don't get reported on. So this is just a small list of retailers that are looking to aggressively expand their occupancy in the next, this is literally within the next 2 years. But the interesting thing is you're going to see a lot of retail folks who have only existed online starting to open brick and mortar locations. Amazon Goes, Amazon Books, because they recognize the brand value in having a physical location. So as we look back to our Mueller model, I think it's safe to say that most of the U.S. overall is heading towards that equilibrium point, that number 11. I know that we kind of placed Missoula retail there as well, but we've had such healthy absorption in 2019, and I know our phones are ringing quite a bit with large retailers looking to locate here, that we do think that we're still in the expansion phase, especially with the hotels, Riverfront Triangle. We think that will be absorbed pretty quickly. And so we're optimistic on where we sit in the cycle right now. And looking at rates, you see actual rent growth over 2018. This is likely because a lot of the weaker retailers are probably weeded out in 2018. We saw some rent dropping in 2018. So I think some stronger, more stable retailers have moved in 2019. But if you notice the column all the way to the right, cap rates have all gone up, pretty much. And so there are investors applying a real higher risk factor to retail acquisitions, and they prefer returns based on in-place income rather than the optimistic pro forma approach. So retailers are definitely a little more leery as they kind of wait to see how this balances out. Missoula had a great vacancy rate in 2019 compared to the national rate. Stable rates overall, not a ton of fluctuations. We had the Merck deliver and absorb right away. Shopko was absorbed right away. So we had really healthy absorption activity in 2019. Moving into some sales transactions, the Shopko was purchased as part of a large portfolio acquisition. So our team did the best to back out what we think the Missoula allocated portion of that was. So that's an estimated price per foot. But sometimes you see, like with the sale of comp number 2, some of these retail properties that were restaurants, they may come with some equipment, licensing, liquor licenses, gaming machines, things like that could boost the price per foot. But overall, pretty healthy user activity in 2019. Median sale price was up to just over $157 a foot. Not a lot of retail investment activity locally. Not enough to actually publish what we feel confident about is an average cap rate for 2019. We talked about absorption before, really healthy year in absorption with the hotel space going right away. A little bit of a drop in rent, but don't forget that rent number is countywide. So that includes some older kind of infill locations, some locations away from the core. That's certainly not indicative of every pocket in Missoula. If we're going to talk downtown rents, I'd say you're anywhere between $18 and $25 a foot triple net. Probably likely on North Reserve too. We anticipate the Riverfront Triangle delivering and being offered at above $25 per foot triple net. So just keep in mind where you are when we're talking about various retail rates. Here's our development tracker. Lots delivered last year, over 180,000 feet. Most of the plan that you see, over 200,000 feet, is included in the Riverfront Triangle space. And then as we wrap it up, opportunities and risk. Value add investment products, always a lucrative project if you can find them. Be prepared to be very actively involved in creating your return on investment there. But those opportunities are there right now in these smaller commercial neighborhood centers. A retail group that has been kind of overlooked and maybe considered unstable in the past is actually emerging as quite a lot more stable as we move forward. Health, wellness, and medical with an aging population, but also younger generations that put more value on skincare, specialized fitness, wellness products, things like that are actually emerging. And anyone that offers some sort of service component is actually proving to be a lot more stable as we move forward. Retail, smaller footprints are going to prevail. The department store is going by the way of the dinosaur. So what you're going to see is the omnichannel concept come forward. And omnichannel is basically your retailer saying, I don't need just my brick and mortar location to reach my consumer. I have online, I have mobile browsing, I have buy online, pick up in store, I have social media. I don't need a huge brick and mortar location, I just want that brand recognition. So I think smaller retail is gonna do really well. And then co-retailing concepts like food halls, open air markets, something that can incubate small businesses, but be a one-stop immersion entertainment and experience for the shopper is going to prove to be probably a good opportunity moving forward. Your risks, can it be Amazoned? If you don't offer any kind of service component, I'm not saying that you're not going to do well, but I would put your use at higher risk than others. Monitor your user growth strategy. How many stores do they plan on opening in the next few years? Are they biting off more they can chew? Just kind of monitor where they are in their growth, and then overbuilding, oversupply. Watch what's planned, watch what's going to deliver so we don't build a bubble there. And so lastly, just to kind of tie in this relationship with one another, there's been an interesting study called the halo effect on brick and mortar and e-commerce. And they actually are working together to improve the consumer experience. So they have found that if somebody spends $100 online and that same brand has a brick and mortar location, they're very likely within the next 15 days to go spend $131 more in the store. And vice versa, they'll spend $167 more online with that brand if they start with a $100 purchase in their store. And the same thing, so consumers are more likely to visit a brick and mortar store as the result of an online purchase. One online purchase can turn into 2.1 in-store transactions. So even though it kind of seems like industrial and retail are doing a little bit of a tug of war here, and in some ways they are, I think retail is just taking a pause and trying to figure out where they fit in the model now. But by no means is it dead. It's just kind of re-emerging and reimagining itself. And so our outlook for retail is optimistic looking forward. So I think that wraps up what I have. And just to keep in mind, none of this matters if these assets are not managed properly. If they're not functioning at their highest and best optimal performance using proper asset management, they're not going to perform for you no matter what. So we're lucky here to have Jessica, who's our asset manager, to kind of talk about the difference between property management and asset management. But Ross will bring you back up.
Thank you, Claire, for that review of the intrinsic fundamentals of our retail and industrial market. And I had to, watching your presentation and thinking about Bryce's comments too, what happens with these extended supply chains to China? And do those get condensed and moved back to Western Montana or other places, especially when you look at those distance travel times that you talked about? So very interesting comments. Well, again, the bar is open. Also a note on parking. There is no need to have your parking slip validated. The gate will be open. So if you do need to leave, just know that that's available. And I'd like to welcome Jessica Morena. Jessica runs Sterling Commercial Property Management, and she manages a variety of assets around Western Montana, nearly 30 separate properties with over $50 million in asset value. And Jessica's going to talk today about the difference in asset management versus income management, and how that asset management approach has a much longer term horizon and benefit for those properties under her management. So Jessica, please join us on stage. Thank you.
There we go. Good afternoon, everybody. I'm going to spend a little bit of time today talking about how asset management differs from your traditional property management and how that really adds value to your property. So if any of you in here own commercial property, you more than likely purchased it as an investment with hopes of growing that investment. You know that its leases and its building systems can be more complicated than residential leases or the HVAC and the plumbing that you find in your home. This is where hiring a property management company can really help with dealing with that property on a daily basis. But if your property management company does not include asset management, they don't have that value-driven focus that an asset manager is going to have. So your typical typical property manager, they'll collect your rent for you, they'll field your tenant service requests, they'll answer questions that you have. But really, on a daily basis, are they looking at ways to grow the value of your property? An asset manager is actively trying to grow the performance of your asset. They do more than just market your vacancies or take your tenant service requests. They're working hard every day to understand the needs of your building, the needs of your tenants, and they also understand targeted remodels and expansions should your property, commercial property, need that. Over the past several years, Sterling CMG has taken on management of multiple properties that have transitioned from that typical property management style into more of an asset management style. So today I just want to share a few examples with you of how having an asset manager has added value to their properties. So for our first example, we'll call this building A. It's 31,000 square feet of office space. It had a 9.3% vacancy rate and a long list of deferred maintenance. So after consulting with the director of this property, it was determined that there were three things they were going to focus on to be successful here. One was increased occupancy, the second was increased revenue, and then implementing a maintenance management plan. So sometimes a monthly or a weekly visit to a property is just not enough. It was determined here that an on-site employee should be available at the property at least 2 days per week due to the size of the property, the number of tenants that it had, which was 24 at the time, and then that long list of deferred maintenance. The frequency of on-site presence here allowed the asset manager to have a full understanding of the building's needs and the tenants' needs, and it allowed them time to build strong relationships with all of the tenants that were there. Because of this on-site presence, 7 different companies within the building have expanded their footprint. So that's 7 different companies that had outgrown their space here. They were going to move out into something that was more suited to what their current needs were. But because the asset manager there was in constant communication with them, they knew what their upcoming needs were. They were able to pair them with upcoming vacancies in the building. And usually the day that an office was vacated, another company took over the same day, which resulted in a $0 vacancy loss. This couldn't have been accomplished without that multiple times per week visit to the property. So in just 11 months, the occupancy of this property increased to 100%. In 2018, the building's market values were reassessed for the first time in many years. When this was done, this reexamination exposed that almost every tenant in the building was paying far less than market value. So at the time of renewal, rents were obviously increased. Now at this point, your traditional property manager is probably happy. Rents have increased and occupancy is at 100%. But an asset manager is going to continue to look for ways to add value to that property. They noticed here that office space was in high demand and low supply, and also noticed that one of the tenants was using an office just for storage simply because there was no storage available in the building. The asset manager was also aware of several storage units on site that the building was using just for building storage. They were able to, in a half a day, reorganize and consolidate those storage units, creating additional rentable square footage for the building, which resulted in $150 a month extra in monthly revenue. The day that that office space was vacated, it was another company expanded into it, so again, a $0 vacancy loss. The office, Then there's also currently plans in place at this building. There's kind of a large unused section of space available that's not creating any revenue. An asset manager recognizes that it could be revenue producing space. They've come up with a proposal to turn this into additional office space for just $6,800. They expect at least $600 per month on this office space, so in less than 12 months, this property is going to see its return on investment. So in just over 12 months, with careful oversight, this property has added rentable square footage and it's increased the revenue by 18%. The last objective here was to implement a maintenance management plan. As mentioned earlier, there was quite a long list of deferred maintenance in this building. So working with the facilities director, the asset manager was able to quickly identify and prioritize all of the maintenance needs that this building had. And not only that, but they were able to implement a preventative maintenance plan. They weren't just concerned with the immediate needs that needed to be fixed, but they were also looking at the long-term health of the building and the building systems that were there and in place, making sure they were able to preserve those for as long as possible. So the additional square footage that the building has created has made it possible to get every maintenance project done. There is currently no pending maintenance work needed because of lack of funds right now. So another aspect of maintenance management in this building was there are some tenants with some pretty specific needs, and the space that they had didn't really currently meet the needs that they had. So the asset manager worked with these tenants to come up with tenant improvement plans. Because they're familiar with this type of remodel or expansion within the building, they were able to do this in-house without hiring a contractor to come in and oversee some of these projects. So again, they've allowed tenants to stay in the building, come up with more efficient space for them, while also adding value to the building. So to sum up example one, by hiring the right commercial property management company, this property has increased rents and occupancy, resulting in an 18% increase in revenue in 12 months. Not only that, they've been able to implement a preventative maintenance plan that was much needed. Tenants here continuously express their satisfaction with the change in management style and are happy. The building is full, the value of the property has gone up. So we feel like this one's been a pretty successful story for us. Our second example we'll call Building B. Building B is an investment property and is made up of multiple suites. When this property was purchased, it also had tenants in place. Throughout due diligence, it was noticed that the previous management company had not been enforcing leases to their fullest effect. This had cost the owners significant amount of money that they didn't even realize they were missing out on. So to be successful here, the asset manager wanted to focus on three things: increasing the revenue, lowering maintenance costs, and then increasing the value of the property. Because this was purchased as an investment property, it was not only important to the asset manager, but the client that we keep value add in mind. So in commercial leases, the revenue that you collect each month can be made up of more than just the monthly rent. Triple net leases allow you to include taxes, owner's insurance, common area maintenance fees, and also property management fees. So if you didn't know that, the property management fees that you thought you'd have to pay can be passed on to your tenants if they're in a triple net lease. That professional oversight that sometimes is lacking is not even going to cost most owners. Leases can also allow you to collect a reserve fund from your tenants each month, and so that's money that you get to tuck away and save for later when you have those expensive projects such as a roof replacement or a boiler replacement. So the inherited tenants in Building B were all on triple net leases and paying monthly triple net fees. But those fees did not include property management fees or the owner's insurance. It's estimated that the previous owner was losing about $10,000 per year because these were not included in the triple net fees. Tenants there were also not contributing to that owner's reserve fund. And like I mentioned before, triple net leases should also include taxes. In Building B's example, there are several costly mistakes that were made when trying to seek reimbursements from the tenants for the taxes. One tenant had not had a triple net adjustment since January of 2011. That is 9 years without an adjustment, or someone looking at that triple net budget and passing on those additional or increasing costs. So can anyone in here raise their hand if they haven't received a tax increase in the past 9 years? Nobody can. And this owner didn't even realize that his property management company was not recouping those costs for him. It was also discovered that a second tenant was not being made to pay their full amount of taxes due. Because this building was made up of condos, each condo comes with its own tax bill. This tenant was being allowed to pay a percentage of their tax bill and a percentage of another condo's tax bill. When you add those together, it did equal up to the correct amount of square feet that this tenant leased in the building, but it did not add up to 100% of the dollar value of that tax bill that was their responsibility. So, had the asset manager continued to collect taxes the incorrect way, they would have lost the new owner $1,300 this year alone. This tenant has 4 more years left in their lease. Multiply that times 5, that's over $6,500 lost because you didn't bill your tenants correctly in your triple net budget. When asked why it was being done this way, the prior management company's answer was the management company before them was doing it that way. Neither one of them had that owner's investment in mind, nor the thought to add value to that property. This is why having an asset manager oversee your commercial properties is really crucial to their success. A third tenant in Building B, also on a triple net lease, had not received a rent increase since 2015. The lease clearly stated that they should receive a rent increase annually based on 100% of the change in the CPI. So from 2016 to 2019, this tenant should have received a rent increase every year. If I'm doing the math correctly, that's $220 a month more right now that tenant should be paying, but it's not. That's over $2,600 lost this year because prior management did not implement rent increases when they were due. Your asset manager knows the leases associated with each tenant. They're not going to skip a rent increase for you. So to increase the revenue in Building B, it was really simple. Implement rent increases where they were due, implement triple net increases where they were due, and make the tenants pay for 100% of the tax bill. These tenants were already there, their leases were already in place. All we had to do was read the leases and implement what was there the whole time. The second objective at this building was to lower maintenance costs. Building B is part of a larger condo association, and your typical manager is going to attend those association meetings, and they're going to take that budget and probably go back to the office and file it away. An asset manager is going to review the budget, they're going to review the contracts the association has with vendors, and they're going to make changes if needed. When reviewing these documents, it was noticed that there were some expenses that were significantly higher than similar buildings the asset manager was familiar with. If management companies have a large commercial portfolio, they're able to quickly identify these services that cost more compared to buildings of similar size. So in just a few weeks, the asset manager was able to provide the association with new janitorial bids, snow removal bids, landscape, and elevator maintenance. This asset manager did not have any part in management of the association, but recognized that by making these suggestions and changes, it was going to benefit their client as well. So now I want to spend a little bit of time just showing you how increasing revenue and decreasing expenses really does affect the value of your property. Because the purchase of Building B is for investments, this is always what the asset manager had in mind. So we'll just use round numbers to kind of make it easy. Let's say the building was purchased for $1 million. The net operating income is $50,000 with a cap rate of 5%. When the new asset manager determined that an additional $10,000 per year could be collected in triple net fees because of the insurance, property management fees, and reserve funds, this has now increased the NOI to $60,000, and the value of the property is now $1.2 million. By collecting taxes the proper way and implementing rent increases when they're due, you've now increased NOI to $63,945, and the value of the property has now increased to over $1,278,000. And when you start to decrease expenses, if we're able to save only $2,000 a year in expenses, which is such a small amount when you're considering spreading that out over 12 months, that increases NOI to $65,945, and the value of this property is now over $1.3 million. Luckily, this owner hired a commercial property management company that took a more active approach to managing it, and this owner has now increased the value of their investment by over $300,000 in just a few months. My final example is going to focus more on just the building systems and maintenance management. So our last example we'll call Building C, which is 20 years old, and it does have a lot of legacy systems in place here. When working with the facilities director to review the systems, they noticed that there were two 50-horsepower motors in the building that moved air through the building. When they were on, these motors were running at a continuous speed, no matter how much air the building was calling for. So as this air moves through, a mechanical damper will open and close to allow the air to move into the building. When this mechanical damper failed, the building could no longer control airflow into the building. So they had no choice but to either make a repair or make a replacement. The mechanical damper could have been replaced for $5,000, problem solved. But there were other options explored first. The facilities director was aware of some energy rebates and knew that there was more out there than just your traditional LED upgrade rebates. So they contracted with an energy rebate specialist, which is at no cost to you as the owner or the property management company. And it was recommended to install VFDs, which are variable frequency drives. So before, the damper would open to 20% if this is how much air the building was calling for. Now with the VFDs, the motors are running at 20% of capacity, which is going to create a huge energy savings going forward. Now, as mentioned, we consulted with an energy rebate specialist, and at the time, there was a $5,500 rebate for installing these VFDs. So this brought the cost from $12,000 down to $6,500. For only $1,500 more, we've solved the problem, but we've also reduced energy consumption in the building going forward. And that additional $1,500 that it cost, we've calculated that payback just on the efficiency of the motors is going to be less than 2 years. So in less than 2 years, we're back down to the $5,000 it would have cost us just to replace the part. But now we've lowered the energy consumption ongoing. So not only has the building's efficiency been increased, but this has also increased the value of the property as well. So the one thing each of these properties has in common is that they're now being managed by a commercial property management company that has asset management at the forefront of every decision. These decisions are meant to grow the value of the property so the owner can grow its return. Not only does an asset manager increase your revenue and look for ways to lower your expenses, but they're going to do it while increasing the value of the property. When you're looking for a property management company for your investment real estate needs, make sure they specialize in commercial property management. Make sure they're familiar with commercial leases and everything that's different from a residential lease with those. And make sure that they think like an investor like you do. And remember, if you've always been hesitant about hiring a property management company, if you have leases with triple net leases, you do not have to pay for that property management fee. Thank you.
Thank you, Jessica. All right, once again, it's time to, I'd like to introduce Matt Malott, who's going to talk through the multifamily and office space markets here in Montana and get back to those same sort of intrinsic fundamentals that we began our conversation with. Thanks, Matt.
So as Ross mentioned before, the bar is still open, so get on it. So multifamily is a pretty popular asset class. We get an awful lot of calls for people looking to get into this or that currently own properties looking for more. So talk about that for the next few minutes here. This should be fast and funny, so if it's not, gong me off and I'll go on to the next slide. The multifamily market cycle, same thing that Claire talked about earlier, is generally, if you look at this, this is all the major metros throughout the country, generally at the peak, so at 11 or to the right, which means it's going into hypersupply. So if you take a look at that, generally that looks like the market as a whole is kind of sliding in the wrong direction. Our assessment of the Missoula multifamily market is that it's 1 to the left, so at 10 on the cycle. As you just doing a quick recap of trends nationally and regionally, in the West, you can see that the basically cap rates are between 4.7 and 5, and then nationally they're between 5.6 and 5.8. So, but across the board, below 6 is pretty common. So this is held true for what we've seen in Missoula as well. And then rent growth is also increasing pretty rapidly, between 3 and 5%, depending. Which bodes well for the asset class and also the reason why so many investors are interested in apartments. One thing to note is that vacancy has spiked up a little bit in our region in the West by about 1% if you're looking at urban Class A properties. If you look at Missoula, not a whole lot has transacted in 2019, but the average, actually no Class A properties, Class B and C properties are in the 5.5% range. And then if you look at vacancy rates for Missoula, it was at about just under 6% in 2018, and it's now fallen by 1.6% basically to 4.4. So pretty big drop there. So something that's important, we interact with a lot of developers, investors, that sort of thing, and they're looking at potentially building new projects. One of the questions that we get asked commonly is, what mix of units do you put into this new project, and how do you figure that out? And the way you do is by paying attention to the types of units that are out there and what the vacancy is by those different types of units. So something you can see here, this is from 2019 data, that routinely the highest vacancy level is in the 2-bedroom units. And then the lowest vacancy is in studios and 3 bedrooms. The 3 bedrooms are generally in pretty low supply, and often investors will not, or developers won't put in 3-bedroom units into their apartment complexes because it's hard to maintain the right rent per square foot to make it worthwhile. In a few minutes, we'll talk about why that's changing and some opportunities there. If you look at this is the submarkets of Missoula that we break out into 8 different submarkets. And the big thing to take away from this is that it's pretty consistent whether you're out in the west part of town where most of the building is happening or throughout the interior of town. It's between 4% and in the 4% range, so nothing higher than that through 2019. So even though most of the supplies come out from Mullen and Reserve area. Looking at the significant sales in the multifamily world, the past year had 54 units sell on Cooley Street, 108 units by the Community Medical Center, and then another 51 units on Burlington. But all in all, the volume was pretty low in Missoula for this year. So as we move on to look at the kind of the development outlook, if you touch this in any way with the lending on it, or you're the developer or investor in these things, it's really important to recognize that population growth, which is the least exciting topic you can probably think of, unless you're involved in apartments and unless you're involved in commercial real estate, in which case it's very exciting because that is what drives a lot of this. So something to take away from this is Missoula County's growth over the last 9 years. And you can see that from 2010 to about 2013 or so, that the growth is pretty flat, below 1%. And that has a lot to do with the job picture in town. And then from 2013 to 2016, it starts to pick up a little bit, and then from 2016 on, it's picked up pretty considerably to where we're now at 2% growth annually in population or greater. And so, again, who cares about this stuff, and why does this matter? If you're investing in these asset classes, how do you predict what the future demand is for apartments if you're investing in apartments? So there's a pretty simple formula that ties back to population growth. So if you can anticipate what the population is going to be, you divide that by what the average household size is. You take the product of that and then multiply it times the percentage of the population that are renters, then you should know how many rental units are going to be demanded in the future. So if you're again, if you're a developer, if you're a lender, you are real interested in this information. And because my mom's a math teacher, I have to put the brackets in there to do it right. So, again, where does this go? So I know that doing complex math problems in public is generally not recommended, but here we go anyway. This will give you an idea of how many units would Missoula County support if the growth rate stayed the same. So it's 2% growth rate last year. If 2% was this year, what would that look like? So population's about 122,370. You have 2% population growth rate. That means that you'll have 2,447 people that would come to Missoula net in 2020. You divide that by the average household size of 2.29, which will tell you that we need, across the board, of all types, 1,069 housing units. So that's single family for sale, multifamily, single family for rent, the whole, across the board. You take that number times the percentage of the population that is renters, which last year, 43% is what the American Community Survey tagged the percent of Missoula County that are renters, which will tell you that we need 460 rental units to keep up with demand. So of all types. And then of that, about 60% of the rental units are people that are in apartments, multifamily apartments. So there you go, 460 units total, 275 of those would be in apartments. So that's at 2%. That's if we continue to grow as we did. But as we talked about earlier, there's a lot of uncertainty. It's hard to predict exactly what will happen. So if we run another scenario and just say that everything else is the same, except our population growth is only 1.5%, you can see that we would demand about 115 less total rental units and about 70 less apartment units. So again, this is very interesting if you're looking at building these, building new properties. How does this all fit in? So this slide here is trying to show demand and supply and then where are there gaps. So if you look at this is from 2010 until 2019. It's all the residential permits issued each year. And this is information reported by the county to the Census Bureau, which is where we pull this information from. And if you look at it, the blue is single-family deliveries, single-family permits. It's not deliveries, it's permits. And then yellow and orange are multifamily. So the other important thing to note here is that if it's permitted in 1 year, for apartments at least, it's probably going to deliver the next year. So its impact on the market will be the following year. So important to note that distinction. So think of these bars as our supply, and then this is the housing unit demand based on population growth and average household size. So by putting these two over top of each other, you can start to spot where there's gaps in supply and demand, which is also where there's usually opportunities. So from 2010 till 2015, you can see that we were generally slightly underproducing the amount of housing units that we need for this market, which caused vacancy rates in apartments and that sort of thing to kind of compress over time. And then the market catches the signal in the 2016 and 2017 timeframe, and you can see that we built a ton of apartments, 1,100 thereabouts, in that 2-year timeframe, so 2016 and 2017. And then those units start hitting the market in real force in 2018, which is why vacancy at that time spiked for apartments. But then the very next year, in 2018, you see that the overall permitting, both the multifamily and, so single families were up slightly, but multifamily was way down, and that trend continued into 2019, and we delivered far fewer than what we needed. So you can see where we have these housing shortfalls, which then does two things. It decreases vacancy in apartments, multifamily apartments, and then it increases prices of single-family rental units, single-family houses too, and the price of them goes up. Both of those everybody's seen. The median home price is up above $300,000, and then the vacancy rates are now coming down on apartments. So, but here is one important takeaway from this is that there's interchangeability between single-family housing that's built for sale and single-family housing that ends up being rentals, and then multifamilies. The overall supply of housing created relative to the demand for those units due to population growth should be viewed more holistically. In the past, we've really tried to segment it out like we did in that previous slide where we say, okay, there's going to be 460 rental units and 275 of those are going to be multifamily. But what we're seeing in practice is that when we're under-delivering as a whole, people who otherwise might have wanted to purchase a house can't do it. And so now they are moving into apartments or staying in apartments, not necessarily by choice, and it's causing the vacancy rates to go down. So crucially important information if you are in the development world especially, but if you're looking at existing properties, you have to keep this in the back of your mind. So as we look at the tracker, basically what development projects are in the works for the future, this also helps to predict vacancy in the future and demand in the future. So in 2019, there was 266 units that we were tracking that were delivered, which is pretty close to what, if you do that formula that I showed before, about what demand is, maybe a little bit under. But if you look now, in 2020, there's only 170 units or 169 units that are under construction. So given the demand curve that we showed, it looks like there's going to be another pretty big gap in deliveries of units versus what is actually demanded in units. So that would indicate that your vacancy is likely to stay tight or even get tighter, if that's possible, in the apartment market this year. One other thing we should recognize from this is that the more difficult that the city and the county make the creation of new lots, by increasing subdivision regulation or by gutting the townhome exemption, or by creating uncertainty as to what it's going to cost in infrastructure if you develop new lots. So the more that the city and county does that, the more apartments and rental communities will be constructed as a percentage of overall deliveries. And the reason for that is because you can generally do an apartment project without having to go through the 2-year struggle of trying to subdivide land. So a lot of developers are saying, well, I'll build apartments because why would I want to fight the city for 2 years and maybe not end up doing the project? So what we anticipate from this trend, so both the demand trend that we talked about in the previous slide and then also what is currently in the pipeline, is that the vacancy rate will stay about what it is or go down in 2020. And then in 2021 and 2 and 3, it's very likely that vacancy will start to come back up for apartments. That's unless the mayor currently has a working group that's working on subdivisions, trying to streamline that process so that it's not a 2-year fight and struggle. And if that is successful and you're able to make new parcels more quickly and then therefore create more single-family homes, then in theory you would have additional supply of these single-family homes. And then you look and see on our chart here in 21, 22, and 23 and beyond, you're talking 2,100 new units of apartments. If those deliver, or if some large percentage of those deliver, you're going to see vacancy rates come back up. So if you invest, develop, finance, or provide guidance to anybody that touches the apartment world, I'd say the 2 things that you want to take away from tonight are that you should pay attention to hiring and job growth, because that is what informs what the population is going to do, because population growth follows job growth. And then you should pay attention to the total amount of housing units that are being delivered. So whether that's single family for sale, single family for rent, or multifamily for rent as well, and then make decisions accordingly. So I'm going to go through, another question that we get often is when we tell people what apartment investments sell for, they can't believe that the cap rates, that they're as low as they are, and they can't see how it works. So we're going to go through a case study. It's an actual example from a property here in town and show how these things can work. Before I do that, very quickly, try to go over some of the terms so that we're all on the same page. Potential gross income, if you think of it, if you have a 50 unit apartment building and all 50 are occupied 100% of the time at market rents, that's your potential gross income. From that, you need to subtract the vacancy and credit loss. So if you don't have it full the whole time, then you have to subtract out that vacancy, which gives you something called effective gross income. From that, you subtract your operating expenses, which would be your taxes, insurance, management fees, that sort of thing, which will give you net operating income, or NOI. So very important term to recognize. NOI divided by the sales price or purchase price of a property will give you the cap rate on it. And all a cap rate is it's basically a way to assess one investment to the next. It's a measure of risk at a snapshot in time. Lower cap rates are lower risk generally, higher cap rates are higher risk. So keep that in mind as we go through this example. So this is all made up. The name 1900 Waverly Street does not exist. That picture is not of a real property in Missoula, but all the other details of this deal are from an actual property that is available for sale here off market. As I mentioned, we get a ton of interest in apartments. People view them as safe. And so you have investors from both locally and then from all over the place that call when we list properties here. And we recently took a 38-unit apartment building to market. And inside of a week of it hitting the market, we had 7 offers, and then 5 additional offers came in after the building was already under contract. So that should give you some sense of how hot the market is. And again, it's not just from Missoulians. These are from people from all over the place that are interested in these assets. So like I said, it boggles their mind that things can trade at such low cap rates, but I will give you my best effort here to unravel some of the mystery of how these things work. So this is a 44-unit property. It's 3 stories. It was built in 2004. It has some deferred maintenance, needs some paint. The roof is probably got a few years left on it, and the rents are about 10% below market. The property is self-managed, which means there's some inefficiencies there where it could, a professional property manager could probably come in and squeeze some additional revenue out of it. The seller states that the NOI, the net operating income on the property, is $250,000. So that's what he's telling us, and that's what he's putting into his offering here. Price is $4.5 million, which works out to about $102,000 per unit. And for comparison's sake, a nearby 54-unit project sold in July for about $84,000 a unit at a 5.6 cap rate. So that gives you the background of the story. So can this deal be done is, I guess, this is the question. So to walk through this, the seller's saying they have $250,000 in NOI. The sale price is $4.5 million. That means you have a 5.55 cap rate, which, given what things have sell for here in Missoula and then regionally and nationally, that's about where they go, which sounds low, but that's what they are. Couple problems, though, is that the seller's NOI is pro forma, and it's a projection based on 100% occupancy. So full occupancy and the current expenses. So there's two big problems with that. One is you have to count vacancy, and not because I say so, but because the bank and appraiser will say so. If you apply a 5% vacancy to this particular situation, your net income is actually $18,000 less than what the seller is saying. Second is the seller is calculating the NOI based on current tax burden and its current assessment. And if any of you have property in Missoula, you have seen that current assessments don't stay current for very long, and when this property sells, the assessment will go up and causing the taxes to go from about $33,000 a year to about $60,000 per year. So that becomes a $27,000 hit to your net income each year, just off the top. So missing this bid is a pretty common mistake that we see with property owners, that they do all their underwriting based on the current assessment, but it will very, very often go up after sale. So something important to pay attention to. So you take the vacancy understatement and then the tax issue, and there's a total of $45,000 in expenses that aren't accounted for in what the seller is stating. So yeah, sellers will often, discount what a scummy real estate broker has to say about any of this stuff. But again, it's not me that matters or any broker. It's what the bank and the appraiser says when you go to finance this thing. So with all that considered, what does that do to the acquisition cap rate? It means that you have $205,000 NOI. If the sale price stays the same, that means your real cap rate is 1 full point lower. It's 4.55. So can that be banked is the big question. So we're assuming a Freddie Mac small balance loan, which is very common, so agency debt to do this deal. And this slide is taken straight from the Freddie Mac website, and they consider Missoula to be a very small market. So if you look at a very small market, they say we need a debt coverage ratio of 1.4, and the maximum loan to value on a refinance is 70%, and then the maximum acquisition loan to value is 75%. So you take those two data points. The reason that people are after agency debt in most cases is because they will offer 30 years of amortization and non-recourse lending. So very attractive to a lot of people. So, and then, for the sake of the argument here, we're saying that the interest rate that we can obtain is at 3.75% on 30-year money. So how does that work out if you pay $4.5 million for this property? Can you actually get the deal done? So remember, the annual NOI is $205,000, not $250,000 after we corrected it. Your annual debt service on that loan is going to be about $187,500, which means you have $17,500 to play with. It's kind of slop margin if things go wrong, or cash that you can actually put in your bank account. So on a $4.5 million property, $17,500 of cash flow is not a lot. And then keep in mind, this has deferred maintenance, so you're going to have to replace a roof at some point. Boilers tend to blow up around 20 years. There's a lot of things that can go wrong. You need some paint. So is that enough cash flow to cover those eventualities when they do happen? The way the bank will assess this is through a debt coverage ratio. And the way the debt coverage ratio is determined is you just take the NOI of the property, you divide it by the debt service, the principal and interest, and that will give you your debt coverage ratio. And it's basically the bank's way of determining how much margin is there if things don't go quite as planned. So this deal, as stated, is 1.09, which is not bankable with any bank that we have really dealt with. So in its current state, the max purchase price with that kind of loan that could be supported based on the bank's requirements would be $3.5 million, which is a full $1 million off of what the seller wants. So that's not within negotiating range in most cases. So what are your options if you actually want this deal? What can you do to close the gap? So you can put more money down, which is not exciting because the more money you put into it, the lower your yield is. Or you can try to negotiate the seller down, which sounds great, but I think he's convinced there is a gold mine buried beneath that property and is not willing to let go of it without a fight. So now what do you do, and can this be salvaged? So if you go out to your some friends, family, and fools, and you convince them to boost your down payment, they'll come invest with you, boost your down payment from 25% to 35%. And in the back of your mind, you're remembering that there's the rents that are below market, so that you could relatively easily make some management changes, get rents back up, and now your overall investment performance starts to look a little bit better. On top of that, rents have been growing by about 2.5% to 3% per year because Missoula's population is growing, and that it kind of carries it along in the tide. So all of those will combine to make the asset look better if you look at it over a period of time instead of just the year one acquisition cap rate, which is what a lot of investors wind up doing. So when you do look at it that way, these deals can start to make a little bit more sense. And then with treasuries falling off a cliff last week, like Bryce mentioned, the 30-year money you can now go out and find, we'll say at 3.5%. So now you have cheaper money. You're doing a 65% loan to value. Your interest rate is 3.5%. You're still doing a 30-year amortization. That means that you can support a loan of $2.7 million, 2.716. And just press the I believe button on that. I can show you how the math is done on that. So at 65% loan to value, that means you can support a max purchase price of 4.18. So now you go to the seller, you present him with the hard realities of multifamily finance, and he realizes the error of his ways, and you agree to this 4.18 million purchase price, and you both live happily ever after. The seller takes the proceeds from the sale, goes and lives in his cabana in the islands, and you get an apartment complex where you get the fixed toilets and chase tenants for the rent. So it's a great trade. I mean, it's the American dream, so there you have it. So that's a bankable deal, and that's how these things will often get done. Overall, the prognosis for apartments, barring Bryce's presentation on COVID-19 and everybody internalizing, is that it's optimistic. People still need a place to live, at least for the next 12 to 18 months. People need a place to live. These apartments tend to perform pretty well in uncertain times because of that basic fact. People need a place to live. So that's also why people are so interested in apartments. Again, important to pay attention to job growth, which feeds population growth, which then feeds the demand for housing, and then monitor the overall residential permitting activity and compare the two. Opportunities in the faster and funny method here is single-family housing for rent, and I don't mean individual houses, I mean 100 and 200 unit housing communities. And the reason for that is as millennials get older and they have kids, they are moving away from urban areas towards the suburbs, quote unquote, looking for better schools and more of a better place to raise kids. And as they do that, there's demand for rental housing in this variety, not in apartments, but in actual houses. So there's one project out by the Y that finished this past year, had about 30 units in it, a bunch of townhomes. Those leased up in about 2.5 months, very quickly. There's a ton of demand for this stuff out there. There's 2 other projects like this in the works that we're aware of that indicates that investors see the opportunity here and are starting to really explore these. Second opportunity is small unit apartments, and I don't mean small unit count, but small footprint. And part of it is that Gen Z, having lived through, so Gen Z is the generation after millennials, having lived through the Great Recession, have actually developed some degree of frugality with their own money, maybe not with their parents' money, but with their own money. And so they're actually good with smaller living units. And the way that you can deliver a cheaper unit is by building a smaller unit. And so you're seeing more and more that the size of these units are coming down. And that's a way to deliver an affordable unit to Gen Z, which is starting, I think they're 23 years old at the upper end and starting to hit the market more and more. So the last one, opportunities, is to build, stabilize, and sell these apartments. If you're an investor or developer, the fact that there are mobs of these people out looking for apartments indicates to me that there is outsized demand for apartments and undersized supply. So if you can provide the supply to them, you will make a premium, and you'll basically take all your profit that you would have by 10 years of holding it and get it in 2 years as opposed to holding it for 10 years. So something to look at. For risk, quickly, is high-end units. If there's times of uncertainty or if there's a deceleration in the economy, high-end units are probably not where you want to be. And then Airbnb and VRBO, you're seeing more of this, where it is a component of even a normal apartment deal where people will rent these out short term. So with the whole pandemic talk, anything related to hospitality is a pretty ugly place to be. And more than that, what you're seeing is that the rates for long-term leases and the Airbnb short-term leases are getting closer and closer over time. So if you're writing an investment plan based on always having the high rate on Airbnb and Vrbo, you're probably going to get squeezed over time, and it's not going to make as much sense to go through the hassle of doing that route. So that is multifamily, and we'll wrap up quickly with office. Again, here's the demand curve. Everything is left at the peak across the country, more or less. And we put Missoula at about a 9 on that on the curve, which indicates that there's some opportunity there. Just doing a quick summary of the performance, you can see that the cap rates are between 6 and 6.5 in the West, and then a little bit higher between 7.1 and 7.4 overall. The one thing to note is that vacancy has went down significantly in the West region. 2% vacancy decline in a year is pretty big jump. So that indicates there's an awful lot of demand for office in our part of the world here. So Missoula, not a whole lot of investment activity. Class A product trading in the 6.8 range, and then the Class B and C product just above 7. For vacancy for Missoula, changed just slightly. It's down about a quarter point year over year. It was 10.4 last year, 10.15 in 2019. For the sale volume, the thing to note here is that the transaction volume is exactly the same. The sale price per square foot is up about 7%. So, and then cap rates are up ever so slightly as well. Quick note on the downtown vacancy is that in 2018, it was at just over 6%, and in 2019, it went up to 12%. That is largely due to some space being available at the First Interstate Bank building. And then at the very end of the year, there was a church that is being turned into office, sort of, that added a bunch of inventory right at the end of the year, and then it caused the downtown vacancy to spike up. This does not include the federal building, so if that does become available to the city and then the city moves out of its current spaces, you will likely see vacancy go much higher initially in the downtown region. And then rents for office space, more or less unchanged, about $14 a square foot, triple net. If you look at the development tracker here, you can see that in 2020, there's actually not that much office space that looks to be delivered this year. We had 120,000 square feet last year. There's 80,000, 90,000 that will be delivered this year. But if you look again into the future, there's 720,000 plus or minus that is in the pipeline for the next 5 to 7 years. So that sounds like an awful lot of space. But if Missoula continues to have job growth, there is demand for this office space, in which case we can absorb between 120 and 150,000 square feet per year. That's if current job trends continue. So in that range, in the next 5 years, we can absorb all this space. If every single one of these that's projected here on the chart actually came out of the ground, which some of them won't, we would be able to absorb all of that if the current trends stay the same. So overall, cautiously optimistic, but again, if there's a deceleration in the economy, the job creation is what drives demand for office space. So looking at opportunities in the office world, Claire hit on it a little bit, but medical office is, you're aligning with demographics when you invest in medical office. This chart is baby boomers over the age of 65. And we're in 2020, and 10 years from now, it's going to be a lot more. And as the population ages, it will increase demand for medical services, which then increases demand for medical office space as well. So if you are positioned in that world, you're probably in pretty good shape. Flex space. I think I've talked about this at all the market watches, and it is a trend that continues, and the demand for this goes up each year. And the short version of flex space is, rather than having space as an asset where you buy the property, that's on one hand, or space as a liability where you sign a 10-year lease on it, most tenants, or many tenants, maybe not most, but many tenants are looking for space as a service, where they sign short-term leases, it's fully decked out, and they will pay a premium to have that flexibility. So these are very common in larger markets. There's one example of that here in Missoula called C3 Work Lounge, which is around 4,000 square feet, and it meets a need in the market. There's things like tech companies, solo entrepreneurs, even large companies that GE is probably not a great example, but large companies that if they have a contract in a certain town and it's a one-year contract, they're not going to come in and sign a 10-year lease, but they will come in and pay you a lot of money per unit for office space for that year while they have the contract. And then if the contract gets renewed, then maybe they look at more permanent space. But the demand for this type of service is growing rapidly. So if you own office buildings or invest in these office buildings, having a flex component to what you do will become more and more important. So as a quick representation of this, you can see that in the past, you have 80% occupancy in a given office building, and it's long-term triple net leases, and you've got about 20% vacancy. And your actual utilization of what you have of that asset is probably only 40% because there's one person per 300 square feet. And then in the last decade or thereabouts, you'll see that about 5% of the overall makeup now is flexible space, this space as a service. And you still have 80% of the traditional long-term occupancy, maybe 15% vacancy, but the square feet per person is going down to 200 square feet. So your utilization rate goes up. The higher your utilization rate is of the asset that you have, this big fixed asset, the better your return is on this on the property. In the not too distant future, it is highly likely that 30% of an office space will be run as a flexible service, and 60% will be just retained as the kind of traditional long-term net lease type of deal. That will increase utilization rates upward of 80%, and with that, the increase in revenue that goes along with it. So, as a quick aside, Sterling CRE has a sister company that it's launching in the next 3 to 4 months that basically provides this service. So it is the options with it, or it can be done as a third-party managed service. So if you're a landlord and you have a space and you want to do flex space, but you don't want to manage flex space, Adaptive comes in and manages this space for you. So you, as a landlord, would invest into the TI required for it and some of the furniture, but then after Adaptive manages the flex space, the increased revenue passes through to you as the owner. The other option is you just have Adaptive sign the lease, just like any other tenant. You have some of the benefits of having all these different types of tenants coming into your building, but you don't have to deal with the outfitting cost at the outset. So flex space, if it is managed properly, decreases overall vacancy generally by 8 to 10% is what they've seen across the board, and then increases net revenue per square foot by 10 to 15% on the flex space itself. So it does require that capital investment up front, but often gets office owners out of the churn of doing TIs, tenant improvements, every time a tenant turns over. So it's becoming more and more attractive to property owners. And then the last opportunity we'll talk about is what we call tokenized investing. We hear a lot that we interact with all these people, very interested in commercial real estate. They like the tangible assets that they can lay their eyes on. It's not ethereal and out in the cloud somewhere. And they want to invest in it, but they can't imagine themselves having the time or the know-how to do it. So into that space steps kind of sponsorships or syndications or tokenized investing, where a sponsor will go out and find a deal and put it all together. And they'll find the land, they'll come up with a plan, and they'll create a prospectus. And then the sponsor puts the prospectus in front of investors who review it like a mutual fund offering. Legal check. Can I actually say that? Is that valid? Okay. It's not an offering. Never mind. So it's a mutual fund. Not a mutual fund. It's forget I said that. Anyways, the investor looks at the investment prospectus, decides, hey, I like this property. I think it's a good location, a good idea. I'm going to put in $25,000, $250,000, whatever it is, and they get a percentage of the deal. The sponsor then takes that money, he invests it, he executes whatever the plan was in the prospectus, and then manages the operations of the building day to day. The investor collects the cash flow from the operations based on their percentage that they have, and then gets their payout of the percentage when the property sells in 5 or 10 years, whatever the agreed upon plan was. So the upside here is that if you're an investor, it can be, if you want it, it is almost completely passive. You put your money in there, and the sponsor's doing his job, and in theory, you collect your revenue coming off of it. It's also useful for investors who want to diversify, whether that's through different geographies or into different asset classes. So if you want to spread money out between apartments and office and different things like that, it provides a great opportunity for that. And probably the best part of it is that you put money in, and generally the investors are not signing on debt. So they are putting their money at risk, they're putting their equity at risk, but they're not signing on a construction loan, they're not signing on some sort of recourse debt. And so you are putting money at risk, but you're getting the returns that are generally higher than what you'll see in a lot of other asset types. So 12 to 20% internal rate of return is not uncommon depending upon these asset types. So the downside of this is that you relinquish some control of the property and on the timing of the sale and that sort of thing. So it's not like you can just go in and say, hey, life changed, I had a medical issue, I need to sell this asset and be out. It generally doesn't work like that. You don't have that kind of control over it, but you are trading, the return and kind of the passive investing. You don't have to do much to it. It's good for people that are busy, business owners, doctors, attorneys, that sort of thing. Like I say, it's great. It's a good match for some investors, but there are very specific regulatory requirements from the SEC, so it's important that the proper channels are followed when investing in these. And then as a last aside here, we have a sister company as well called Sterling Capital Investment Group, which does these sorts of things. So they put together sponsorships for office, apartment deals, and so forth. So if that's something that's of interest to you, I'm happy to talk. Lastly, Sterling CRE, we don't provide tax, legal, or accounting advice. If you have those questions about your specific situation, then you should talk to your CPA or your tax attorney. And we would greatly appreciate your feedback on this event. We'll send a quick, probably 1 or 2 minute survey out to you by email just to hear what you liked or didn't like about the event so that we can tweak next year's event and make it better. Finally, I'd like to thank Sarah Townsley, who is in here somewhere. So all the data that we collect here is done, most of it is done manually, and the person that does that is Sarah, and she's been doing it for 3.5 years now, and it's why we have this data set that we do and are able to present this information to you. So without Sarah, this is literally not a possible thing for us to do. So thank you to Sarah. We appreciate you coming tonight. Thank you for your time. Please come find us, any of the speakers afterwards with questions, and we hope you have a great night. See you next year.